Today, the QE factor, why investors face recurring market volatility and uncertainty ahead. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news with a distinctively Australian flavour. And just before we start, a quick reminder that tomorrow, Tuesday at 8 p.m. Sydney time, you can join us for a live discussion about investing and the financial markets with Damien Klassen from Nucleus Wealth and What the World Fund. Should be an interesting discussion, lots to talk about, and you can ask a question live, so mark your diary. In today's show, we consider the implications of the mega QE programs currently in force and whether this can really be reversed, plus market reaction to Evergrande, calls for central bank reviews, and how first-time buyers are gearing up despite the uncertainty. Moody's said last week's market responses to China's Evergrande group shows how financial events in one part of the world can reverberate and jolt credit conditions elsewhere through abrupt shifts in sentiment and liquidity. They expect episodic volatility to recur in the coming quarters as concern about the sustainability of higher corporate and government debt burdens rises, with the likelihood that monetary policy will gradually become neutral in 2022 after being accommodative this year, although I think QE will go on for longer than that personally. Markets reacted to the thought that China's Evergrande Group, China's largest property developer of course, may be unable to meet its domestic and international debt obligations, and that's rattled local and global financial markets. Although the equity markets in advanced economies do not usually react so strongly to news about an individual company in China, it's likely the Evergrande news also triggered concerns about Chinese growth, which would have global implications. Given that market participants were already assessing inflation risks, a potential standoff on the US debt ceiling, possible US government shutdowns, and imminent tapering of asset purchases by the US Federal Reserve, this triggered significant market volatility. And I would say this also gives an insight into the Chinese property market and the highly leveraged state of many buyers there, much higher than even in the highly leveraged Australian market. So we would expect to see more volatility ahead, but the broader financial and economic effect of each episode will depend on the macro financial and policy settings which occur at the time. At the current juncture, Moody expects that governments and monetary authorities will act to contain risks and the ongoing economic recovery will continue, and we expect that their actions will mitigate the damage to credit conditions from heightened risk aversion. In other words, more stimulus and support despite the tapering talk. Additionally, equity prices remain high as measured by some traditional metrics, such as price-earnings ratios. Alternatively, high equity market valuations could be explained by low benchmark interest rates and a larger than usual equity risk premium. The emergence of one or several downside risks, though, could lead to a market correction, they say. And they note that although various factors may have cooled investors' risk appetite, they seem not to have dented broader expectations about the global economy. For instance, the 10-year US Treasury note yield, that's a global interest rate benchmark of course, has remained low but broadly stable throughout September, rather than falling as would be likely amid acute concerns that the still ongoing economic recovery was faltering. And high-frequency global real economy indicators seem to support broad recovery expectations, although I could point to a few that aren't. The market's muted reaction to the September Federal Open Market Committee meeting indicates that participants viewed tapering and rate lift-off signals as consistent with the strength of the economic recovery and did not consider them overly hawkish. The FOMC did not announce tapering plans in its September statement, but signalled that the economy has made progress towards its maximum employment and price stability goals, which are necessary conditions to begin tapering asset purchases. Federal Chair Jerome Powell, in his press conference, clarified that a tapering announcement could be made at the next meeting and that monthly asset purchases would end by the middle of 2022, provided the recovery remains intact. On interest rate increases, the September summary of economic projections show that FOMC members are now evenly split on starting to hike the Fed funds rate in 2022 or 2023, depending on the realization of individual FOMC members' growth, unemployment and inflation projections. Financial markets are the global economy's so-called jump variable, where the initial assessments of news and shocks are first visible in hard data. However, based on shared expectations of continued global recovery, although at varying speeds across countries, and policymakers' likely actions to contain risks, they expect equity market volatility to be short-lived, but more common in the coming year. Although investors face future instances of volatility and uncertainty, contagion from China's equity market volatility to global financial markets is likely to be relatively modest because of the limited financial linkages between China and other major economies. But downside risks to global growth from a slowdown in China risk roiling international financial markets, as what occurred in 2015, is certainly possible. That year, China's growth slowdown was primarily driven by a weakening in real estate construction and exports. Furthermore, with corporates and sovereigns coming out of the coronavirus pandemic with higher debt loads, they expect to see more instances of short-lived volatility in response to both negative and positive news about bellwether companies and debt issuers. Now, over on Livewire, John Abernathy from Chime Asset Management made the point that back in 2014, the former head of the US Federal Reserve, Ben Bernanke, stated the problem with quantitative easing is that it works in practice but doesn't work in theory. The simplicity of that statement, made by the architect of the US monetary policy response during the heights of the global financial crisis in 2008, underlines the problem that confronts analysis regarding the outlook for the world economy and investment markets in 2021. The predicament is made no easier as the COVID-19 crisis is managed by vaccines whose long-term efficacy is still based on theory rather than practice. Based both on Bernanke's comments and observing the meanderings of the monetary policies across the world, it is arguable that no central banker, no policymaker, no regulator, nor any government advisor truly knows what the long-term consequences of those historic policies will ultimately be. And it's notable that the political leaders of the free world rarely, if ever, use the word QE in discourses with their citizens. Remarkably, that is the case even though it is the essential plank of their economic policy settings. Compared to their discourses on policy regarding COVID-19 and the need for vaccination rates to rise, the difference in terms of transparency is stark. Certain monetary policy settings have become oppressive for many citizens of the Western world. Two in particular stand out. First, the maintenance of negative real interest rate degrades the value or purchasing power of average people's savings as they are eroded by inflation. This policy is rarely acknowledged or justified by central bankers. And second, monetary policy is stoking asset price inflation, most notably in housing prices, which simply makes the quest to own a home for young families today or tomorrow unattainable without access to more cheap debt. And he says, it's my view that central bankers are rarely proactive and they tend to be aggressively reactive. They are seemingly sanguine as to the long-term repercussions of their policies. For example, in Australia, the utilisation of QE was belatedly adopted in 2020 when it was undertaken in response to the onset of the pandemic. Up to that point, the RBA had stated that it saw no need for QE, even as all major overseas central banks had already adopted QE and done so for many years. In Japan, it has been adopted for 20 years to deal with rolling deflation and the management of their growing government debt. In both the US and Eurozone economies, QE was implemented and sustained as a response to the meltdown in financial markets and the ongoing risk to financial institutions flowing from the GFC. Today, QE is undertaken by central banks right across the Western world, including aggressively in New Zealand, and it has been instigated in India. It seems sensible to suggest that QE will be rolled out in some form in China as authorities grapple with the restructuring of the property giant Evergrande. Now, it's worth then reflecting once again on the recent House of Lords report, which looked at QE in the UK. The authors, including one of the architects there of QE post the GFC, Mervyn King, makes the point that in the real world, QE has failed and it's become more a question of keeping government borrowing costs down, and there is no easy path to reverse course. In other words, QE becomes a permanent and destructive force in the global and local economy, forcing asset prices higher whilst killing off swathes of small businesses and getting households to take yet more debt. As Ben Bernanke stated in 2014, QE works in practice, and therefore we can conclude that it will be maintained as a policy until it doesn't work. Of course, that begs the question, though, as to what working means, and for whom is it working? I think we need to take a real hard look at the real effects of monetary policy and QE in particular. And there is talk that the Reserve Bank of Australia may face its first independent review in 40 years, which might be the chance to bridge the gap between monetary and fiscal policy, but also to boost the bank's monetary policy credentials. Recently, international think tank, the Organisation for Economic Cooperation and Development, or OECD, called for a review into the RBA, noting its failure to meet key economic targets in recent years. Just hours later, Treasurer Frydenberg backed the OECD, noting he was open to a review, but one that would likely have to take place post-election. That is a real issue, and it's something I will give consideration to in terms of looking at the RBA, looking at the monetary policy settings, and learning from the experience of this pandemic, Frydenberg told Sky News. Commenting on the developments, Economic Policy Programme Director at Grattan Institute, Brendan Coates, said there are several reasons warranting a review, including some of the more prominent central bank failures. Firstly, they probably haven't done as well as they should have in the last few years. There are always benefits in hindsight, but an objective assessment of the Reserve Bank in the past few years is that it really hasn't lived up to its objectives. It hasn't met its targets, Mr. Coates said. The most important target the RBA has failed to meet is inflation, essentially resulting in a decade of lost wages growth. Consistently low inflation basically means the economy is not running as hot as it could, he said. Noting that a review does not necessarily spell doom, Mr. Coates highlighted the opportunities for change, including a good look at the bank's governance structure and at the divide separating fiscal and monetary policy. The Reserve Bank board is an outlier. It has mainly been composed of business people who do not have a lot of expertise in monetary policy. That is actually very rare globally. Most central boards are made up of people who know monetary policy really well, Mr. Coates said. Beyond the board, Mr. Coates also sees challenges with the tools the RBA uses to manage the economy, interest rates. It raises the question, do central banks have the tools to manage the economy, he said. That leads to questions about what role does fiscal policy play? Do we keep the independence between monetary and fiscal policy during this period? Noting that he does not necessarily want to see more government oversight of the RBA, what could be explored is means to allow fiscal policy to act more like monetary policy. Could you use more automatic stabilisers in the budget? Should the rate of unemployment benefits vary based on the state of unemployment in the economy, he said. The answers, Mr. Coates hinted, could in fact lay in breaking the separation between fiscal and monetary policy, especially in times of crisis. But actually, the question needs to go deeper than that. Do we actually need central banks at all? Are they in fact a sign of the overarching control of the finance sector, directly and indirectly, on society? And are there ways to escape the QE cul-de-sac? Well, not for as long as politicians are willing to wash their hands of the social consequences of QE, and while central bankers are viewed as godlike entities who can never be questioned. I'm amazed how weak the tenor of questioning of central banks is, especially in Australia. It seems the missive comes down from the mountain after each first Tuesday of the month, and economists and journalists spend their time parsing its contents, seeking and interpreting meaning. They have become high priests, propagating the message, but no more than that. But there are real-world consequences for households and business. For example, over in New Zealand, the latest Reserve Bank figures there shows that first home buyers in August were down by 14.6% to just 2,497. Despite this, though, their share of the housing market increased. The decline was not surprising given the severe restrictions imposed on real estate activity in August, due to the COVID-19 lockdown in place in the second half of the month. However, the figures suggest that first home buyers more than held their own in the market, with the Real Estate Institute of New Zealand reporting residential sales in August were down 26.5% compared to July. That means first home buyers accounted for an estimated 43.4% of residential sales in August, up from 37.4% in July. That puts first home buyers' share of the market at its highest level since June last year. However, while the number of first home buyers who got into their own homes declined in August, the average amount they paid for a home and borrowed from a bank continued to increase. The average mortgage issued to first home buyers throughout the country in August was $557,068 New Zealand dollars, which suggests an average purchase price of around 700,000 New Zealand dollars. That takes their average mortgage payment to over $1,059 a fortnight at a rate of 2.82% with a 30-year term. Unfortunately, the number of first home buyers purchasing properties with low equity loans, less than 20% deposit, is also continuing to rise. In August, 37% of the loans approved for first home buyers had loan-to-value ratios greater than 80%. That figure has been steadily increasing since March, when it was at 31.9% and is heading back towards the high of 40.3% achieved in May last year. And ahead, first home buyers' access to low equity loans is likely to be crimped by new LVR restrictions being imposed by the Reserve Bank, which may also have a chilling effect on the account they are able to pay for a property. But standing back, we really need to have a deep question mark attached to quantitative easing, because so far as I can see, there is no way back from here, and whilst there is talk about tapering and lifting interest rates, etc., the broader risks to the financial markets will mean they will go on pumping for a long period of time. That in turn translates to higher asset prices, including house prices, as well as stock market prices. But underlying all of this, there are higher risks in the system as debt continues to expand. There is definitely a question in my mind as to whether really central bankers know what they're doing, or whether in fact they're being adequately tested and questioned by those who should. We are, I think, in a bit of a cul-de-sac at the moment, but the bottom line is this: you've got to expect more market volatility in the weeks and months ahead, and certainly risks to the downside continue to increase, not least because valuations are so stretched. That's true for housing, as it's true for the stock markets. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.